Hello everyone. Welcome back to Financial Path. Most people think $100 isn't enough to invest. It's barely enough to fill your gas tank, pay for your dinner, or cover your phone bill and part of your other utility fees. I previously had the same thought. But here's the part maybe they never tell you. That same $100 could be the beginning of something much bigger. What if I told you that $100, if invested the right way, could grow into thousands, even tens of thousands, and over time? And no, you don't need to be a financial expert or time the market perfectly. In this video, I'm going to walk you through exactly how to start investing with just $100, step by step, in plain English, with zero jargon. You'll learn where to invest, how to do it, and why starting small might be the smartest financial decision you ever make. And by the end of this video, you won't just see investing differently. You'll realize that wealth building isn't about how much you start with, it's about how soon you start and how smart you stay. One of the biggest myths in personal finance is that investing is only for the wealthy, the people who already have thousands, maybe even tens of thousands, sitting in their bank accounts. But the fact isn't like this. You don't need to be rich to start investing. Conversely, you need to start investing now to become rich eventually. So not rich enough to invest, but invest anyway and then become rich. The hardest part of investing isn't choosing the perfect stock or predicting the next market move. It's just getting started. It's about breaking that mental barrier that says, I'll wait until I have more. However, we should be clear that $100 is more than enough to open a real investment account and start growing your money today. That one small step, even if it feels insignificant now, builds the foundation for the habits that actually create wealth over time. You're not just investing money, you're also investing in your future behavior. You're building the muscle of setting money aside and putting it to work. If you start today and stay consistent, even with small amounts, the long-term rewards can be life-changing and leave you in awe. Therefore, from the above discussion, it should be clear that investing is not about waiting until you have more or sufficient funds. It's about doing more with what you have right now. So, the $100 is already enough to start your first step in investing. Before I further illustrate the potential returns on a $100 investment, let's examine a specific statistic provided by NYU Stern Business School to demonstrate what could happen when you put $100 to work after you give it a long time. Take a look at this chart. It shows how a simple $100 investment made back in 1970 would have grown by 2022, depending on where you put it. Let's start with the safest option, U.S. Treasury bills. These are short-term loans to the government, incredibly stable and reliable. But that safety comes at a price. Your $100 would have only grown to around $2,300 over 50 years. It's ideal for preserving value, not building wealth. Usually it barely keeps pace with inflation. Next up, real estate. Many people believe that buying property is always the best way to invest. However, the National Home Price Index indicates that $100 invested in real estate would have only grown to approximately $1,500. Real estate can be great for owning and living, but as a passive investment, historically slower growth. Yes, even real estate underperformed when compared to other options. Then we have corporate bonds, loans to large companies. These are less risky than stocks and provide regular interest. They're great for conservative investors or retirees. From the chart, we can see that a $100 investment made back in 1970 would have become around $7,800, solid, but still limited. Finally, we have the S&P 500, a broad mix of America's largest companies. Here's where the magic happens. That $100 would have exploded to over $22,000. That's not a fluke. Stocks grow with the economy. You're owning pieces of real businesses that expand, innovate, and create profits. At the same time, compound growth is also applicable to investments. That's the power of long-term investing. Multiple studies consistently show that the S&P 500 outperforms most other U.S. assets over the long haul. Now imagine this. Instead of just investing $100 once, what if you put in $100 every single month? Let's say you keep doing that for 50 years, and the market gives you a modest average return of 7% per year, including dividends. By the end of those 50 years, your total contributions would be $60,000, but your investment could grow to around $544 or $800. That's nearly $500,000 in growth from just a small monthly habit. Most of that money doesn't come from what you saved, it comes from what your money earned over time. The statistics and further recurring illustrations demonstrate what $100 can happen if you start early, stay consistent, and let compound growth do the heavy lifting. You've seen the power of investing $100 each month. Now it's time to take action. So, you're ready to invest that $100. But what exactly should you do first? Let's break it down, step by step, using simple tools that anyone can follow. Step 1. Prepare before you invest. Before putting a single dollar into the market, it's important to build your foundation. That means 3 things. 1. Set up an emergency fund. Life happens. A car repair, medical bill, or job loss could hit at any time. Aim to have 3 to 6 months of living expenses saved in a high-yield savings account. That way, you won't be forced to pull money out of your investments at the worst possible time. 2. Know your goals. Are you investing for retirement, a house, general wealth building? Your goals affect the type of account and investment you choose. The clearer your purpose, the smarter your plan. 3. Understand your risk tolerance. Some people sleep fine knowing their investments could swing up or down. Others panic at the first dip. It's important to choose investments that match your comfort level so you can stick with them long term. Step 2. Choose the right type of account. There are 2 main types of accounts you can use to invest your $100. Retirement accounts, IRA or 401k. If you're investing for retirement, consider opening a Roth IRA or a traditional IRA. These accounts offer tax advantages that can help your money grow faster. Many providers now offer IRAs with $0 minimums, including Fidelity and Schwab. Taxable brokerage account. If your goal isn't retirement, maybe you want access to your money sooner, then a regular brokerage account is the way to go. You can invest in stocks, ETFs, or index funds and withdraw anytime. Just be aware that profits may be taxed when you sell. Either way, look for a platform with no account minimums, commission-free trades, and the ability to buy fractional shares. Step 3. Pick the right investment option for beginners. Here are 3 great ways to invest your first $100, even if you're brand new. 1. Index funds or ETFs. These let you invest in hundreds of companies at once, like the S&P 500. It's like buying the whole market in one shot. Options like VOO or SPI are low-cost, well-diversified, and proven performers over the long term. 2. Fractional shares of big companies. Always wanted to invest in Apple or Amazon but can't afford $100 per share? Fractional shares let you buy a slice of the stock, even for just $10. It's a great way to start learning and stay engaged. 3. REITs, real estate investment trusts. Want to invest in property without owning a home? REITs let you do that. Funds like VNQ offer exposure to real estate with just a small amount of money, and they often pay dividends too. Other beginner-friendly options include robo-advisors like Betterment or Acorns, which automatically invest your money based on your goals and risk level. Perhaps you are not familiar with the term robo-advisors. Here I give a brief description to clarify it. If you're not sure how to choose your investments, or don't want to spend time researching, there's a simple option called a robo-advisor. A robo-advisor is an automated investment service. You answer a few basic questions, like your age, goals, and how comfortable you are with risk, and the platform builds a portfolio for you using low-cost index funds or ETFs. It automatically spreads your money across different assets to reduce risk and match your goals. It even rebalances your portfolio over time to keep things on track. Some popular robo-advisors include Betterment, Wealthfront, and SoFi Automated Investing. They're great for beginners who want a hands-off, stress-free way to invest, and many of them have no minimums or low fees. Step 4. Automate your investment plan. This is where the magic happens. Instead of trying to time the market, a smarter strategy is to set up a recurring investment, such as $20, $50, or $100 per month. That's called dollar cost averaging, and it helps reduce the risk of buying at the wrong time. The best part? Most platforms let you automate the entire process. Set it once and your money gets invested every month. No stress, no guesswork. This not only keeps your plan on track, it also helps you build a strong financial habit. Step 5. Monitor and adjust over time. Even though automation does most of the work, it's still smart to check in once or twice a year. Ask yourself, have your goals changed? Can you afford to contribute more now? Is your risk level still the same? If your income goes up, consider increasing your monthly amount, even just a little. And if the market dips, don't panic. Remember, long-term investing is a marathon, not a sprint. At the end of the day, investing $100 isn't just about making money, it's about starting a habit that grows with you. You don't need to know everything right now, you just need to start, step by step, one smart choice at a time. Here's one of the biggest mistakes beginners make. They either never start, or they try to get rich overnight. Some wait years thinking they need thousands to begin. Others jump into high-risk trends, such as meme stocks, penny stocks, or random cryptocurrencies, hoping to double their money fast. However, the truth is that the market doesn't reward speed. It rewards consistency. Wealth isn't built by gambling. It's built by starting small and staying the course. Even worse, waiting to start could cost you far more than you think. If you delay investing for just 10 years, you could miss out on tens of thousands of dollars in growth, even if you contribute the same amount later. That's the power of time and compound interest. So don't wait for the perfect moment or the perfect amount. The best time to start was yesterday. The second best time is today. You don't need a finance degree, a six-figure salary, or perfect timing to start building wealth. You just need to take the first step. Starting small is not a weakness. It's a strength. It means you're building the habit, developing consistency, and giving yourself time to grow. Here's what you can do today to get started. First, open a free investing account. Most platforms now offer commission-free trades, no minimums, and user-friendly apps to make investing accessible for anyone. Second, choose something simple and strong, like an S&P 500 ETF or even a fractional share of a company you believe in. Don't overthink it. Third, set a small recurring investment, even just $20 a month. Automate it. Make it part of your routine. By doing these three things, you're already ahead of most people who are still waiting for the perfect time. The truth is, there's no perfect time, but there is a real opportunity. If $100 invested once can grow into over $22,000 over time, just imagine what $100 every month could become. Your future self will thank you for starting today. If you learned something today, give this video a thumbs up to support the channel. Got questions about your first investment? Drop them in the comments. I read and reply to everyone. And if you're serious about building your wealth from the ground up, subscribe to Finance Path for more simplified, beginner-friendly investing tips.